Hello, I'm Natalie Kenway, Global Head of ESG Insight at ESG Clarity, and welcome to The Green Dream, the video series where we interview senior members of the responsible investment industry. So today I'm delighted to be joined by Matt Lawton. He is Portfolio Manager at Rowe Price, responsible for the Global Credit Impact Fund. Thanks a lot for your time today, Matt.
Thanks for having me, Nat.
First of all, I wanted to ask, how can fund managers achieve impact in fixed income, particularly in the US where you're based?
Sure. So first and foremost, I think it's important to recognize the role that fixed income markets can play in helping to deliver impact. The UN estimates $5 to $7 trillion of investment is needed per year through 2030 to achieve a set of the UN Sustainable Development Goals, or SDGs. Now, that level of scale of investment simply cannot be achieved through private markets alone. So fixed income, and particularly corporate credit, will be necessary to help facilitate the flow of capital from end investors to those issuers and projects that are best placed to drive environmental and social impact at scale. Now to the question in terms of how can fund managers do it, I'll call out two direct investment channels that we target in our impact credit fund. So one is through ESG labeled bonds. So these are green, social, and sustainability bonds where proceeds are allocated to discrete environmental and social projects that will deliver material and measurable environmental and social impact. So an example could be a US regional bank that's financing the construction of low-income housing. Could be a water technology company that is investing in projects that is going to improve water recycling, reduce loss. Or it could be, maybe in a more controversial example, an auto company that is raising green bond proceeds to help finance their transition from a combustion engine fleet to an electric vehicle fleet. The second channel for investment impact is through conventional bonds that are issued by companies whose everyday activities provide material, environmental, and social impact. So it could be an example of, say, a US-based renewable energy developer or a not-for-profit pediatric hospital. And I think it's important that fund managers look beyond ESG labeled bonds into the conventional bond space for the high impact potential that those issuers and bonds can provide. And then just lastly, impact is not just about investing in a company, measuring the impact and calling it a day. It's really important for managers to seek additionality, and one avenue for additionality for impact is through engagement. So I think it's important that fixed income managers engage with their investment companies. They work alongside their investment companies, helping them to improve in certain areas, and then hopefully, ultimately, progressing their investment companies along their impact journey.
Fantastic. Could you talk a bit more about the engagement side of things from a fixed income perspective?
So when we engage with our investment companies, we're usually seeking one of three objectives. One is to inform our impact thesis, maybe get some data that is missing. The second would be to investigate if there's a particular area of concern that we need further clarity on, and we'll seek investigation through the engagement. And the third is influence. So if there's a particular practice or area that we believe our investment company should be improving, then we'll offer our guidance, our counsel on how they can best achieve that. And hopefully they follow our counsel and advice, and then that leads to positive impact outcomes for our clients and for the planet.
Okay, great. And I understand there have been some good performers on the Global Credit Impact Fund. Could you talk us through some of those? What's been successful? What do they do?
So I think there's a myth out there that investors who want to invest in a sustainable or impact fund need to accept below market returns. And I could not disagree more with that statement, particularly in credit investing, where a manager can capture alpha from a variety of different sources that are independent of the impact case. Think of things like sector, country, currency duration, et cetera. But to your question, let me just call out a couple examples in our impact credit fund that have delivered both positive impact and alpha over the period. So one is NextEra Energy Partners. NextEra Energy Partners is a US-based renewable energy developer, has an industry-leading portfolio of wind, solar, and battery storage assets. In 2020, their renewable assets generated over 18 million megawatt hours of generation. Now that renewable energy generation led to 9.7 million metric tons of carbon that was avoided. So obviously very positive impact from a climate perspective. Now from a financial perspective, it's a 2-year bond, BB rated, yielding a little bit north of 4.5%, while also benefiting from that secular shift towards renewable energy adoption in the US. So a pretty attractive balance of both impact and alpha potential. And the second example I'd call out is European Investment Bank. So they issued a sustainability bond where proceeds went towards financing public healthcare response to the COVID-19 pandemic, went to a number of healthcare facilities across Poland, Croatia, and Spain. And those proceeds went towards the treatment of 60,000 patients, a population of over 12 million that benefited from improved health services. So again, very, very positive from a social impact perspective. And then from a financial perspective, the bank is AAA rated, very high quality, very defensive. And if you think about the very uncertain and high macroeconomic volatility environment we've been living in for the past several months, has performed very well. And again, this is a 5-year bond trading at 91 cents on the dollar. So attractive again from a financial perspective.
Great. I'm really pleased that you touched on what you call the myth there about sacrificing financial returns. Yeah, it's really important that investors understand that it's the opposite in most cases. And what would you say is your outlook for the ESG fixed income space in the US? It can only grow from here, right?
Yep. So I'd flag two points from an outlook perspective. So one is more an increased ESG labeled bond issuance. Now, obviously, in 2022, overall corporate debt issuance has been a bit more muted given the volatile backdrop. But I fully expect ESG labeled bonds to continue to increase their market share of overall corporate debt issuance. I think we'll see new sectors, new issuers come to the market. In fact, just last week, we had General Motors, a US auto company, issued their first green bond to start financing their transition from ICE to electric vehicles. And as an impact investor, I'm super encouraged to see new companies, new sectors jump into the market, because today, over 70% of green bonds come from two sectors, financials and utilities. So from an investment perspective, I'm really excited to see a more diversified pool of investment opportunities. So that's point one. Point two would be continued heightened skepticism of sustainability linked bonds. So sustainability linked bonds are securities where financial penalties could kick in if the issuer doesn't meet certain sustainability targets by a defined date. This is potentially a very, very powerful tool for companies that genuinely want to transition their businesses, but perhaps don't have a deep pipeline of environmental and social projects to finance. Unfortunately, this label, the sustainability linked bond label, has been riddled with greenwashing. Unambitious sustainability targets, minimal coupon step-ups if the targets are not met. And in some cases, we've seen bonds that have been callable by the issuer even before the sustainability targets have even been measured. So completely undermines the whole the spirit of the label. So unfortunately, this label has been abused, and I hope that investors will be increasingly discerning when they're evaluating these bonds for their portfolios.
Absolutely, thank you. We always finish the Green Dream with this question: what is your favorite sustainable food or drink or snack, or perhaps there's a restaurant or service that comes to mind?
Yep. So I'll tell you something that's been a big hit with my family, my wife and daughter in 2022 has been at-home juicing. It's one of those rare instances, at least in my experience, where a New Year's resolution has actually formed into a habit. So it's great. We've experimented quite a bit with it. Some good, some not so good, but I'll just call out my favorite one in particular. It pulls together carrots, bell peppers, celery, ginger, and oranges. A drink that is aptly named Orange You Happy. Not only is it delicious, but obviously it avoids the packaging, the waste disposal, and it's a little bit easier on the wallet from going to the store and buying it pre-made. So for anyone that's into juicing or considering juicing, you can look it up, by name, Orange You Happy. Highly recommend, very delicious and obviously very sustainable.
Sounds great. Well, thank you so much for sharing that with us. It's been great talking to you, Matt.
Thank you.